one where McDonald's corporate benefits handsomely whether his restaurant becomes wildly successful or merely stays afloat, because either way, the rent check needs to clear every month. This wasn't cynicism on Sonneborn's part. It was financial engineering of a kind almost nobody in the restaurant industry had attempted at this scale before, and the results were almost immediate. After McDonald's fully adopted this real estate model, the company's expansion accelerated dramatically because it now had a reliable, growing stream of property-backed income to reinvest into buying more land for more locations. But that's only the beginning of why this model became so powerful, because the real genius of it wouldn't fully reveal itself for decades, as inflation, rising property values, and thousands of individual restaurant leases compounded into something extraordinary. Here's where things become interesting from a purely financial engineering standpoint. When McDonald's signs a long-term lease or takes out a mortgage on a piece of property, it typically locks in a fixed cost for decades. But the rent it charges franchisees isn't fixed in the same way. It's calculated as a percentage of that individual restaurant's sales, which means as prices rise, as the local economy grows, and as that restaurant's revenue increases year after year, McDonald's rental income rises right along with it, even though its own underlying property costs remain largely locked in place. This creates what's sometimes called a widening spread. The gap between what McDonald's pays for the land and what it collects from the franchisee grows wider every single year, almost automatically, without McDonald's corporate having to do anything differently. It's a financial structure that quietly compounds in the company's favor, decade after decade, largely independent of how good or bad any individual burger recipe happens to be. Consider Sarah, a financial analyst studying McDonald's balance sheet for the first time. She might expect a fast food company's most valuable asset to be its brand, or its recipes, or its supply chain relationships. Instead, she'd find that the overwhelming majority of McDonald's total assets are tied up in property and equipment, the physical land and buildings underneath its restaurants. In practical terms, an investment in McDonald's stock is, in a very real sense, a bet on a globally diversified real estate portfolio that happens to have burgers cooking on top of it. This also explains something that puzzles a lot of casual observers. Why does McDonald's franchise so aggressively instead of just owning and operating every restaurant itself? The answer connects directly back to the real estate model. By franchising the vast majority of its locations, currently around 95% of all McDonald's restaurants worldwide, the company shifts the operational headaches of hiring staff, managing inventory, and running day-to-day store operations onto local franchisees, while McDonald's corporate keeps the two things that actually generate the most reliable, highest margin income, the underlying real estate and the brand license itself. Understanding this leads to an even bigger question, though, because owning real estate is one thing, but McDonald's isn't just a passive landlord. It also actively controls what happens inside those restaurants, and that control turns out to be just as financially important as the land underneath them. Most people stop the analysis here, assuming McDonald's real estate strategy is simply a clever way to collect extra rent. But there's a deeper mechanism at play, and it has nothing to do with money directly. It's about control. Because McDonald's corporate owns or controls the land and building for most of its restaurants, franchisees don't just have a business relationship with the company, they have a landlord-tenant relationship, with all the legal leverage that implies. If a franchisee ignores McDonald's operational standards, cleanliness requirements, menu consistency, customer service expectations, the company doesn't just have to rely on friendly persuasion. Franchise agreements are typically structured so that violating brand standards can trigger a breach of the lease itself, giving McDonald's the ability to terminate the franchisee's right to operate that location entirely. This is precisely why a McDonald's in rural Alberta and a McDonald's in downtown Miami feel remarkably consistent. The same general menu, the same cleanliness standards, the same operational rhythm. That consistency isn't an accident or simply good training. It's backed by genuine financial and legal leverage, because the franchisee's lease, not just their franchise agreement, depends on maintaining those standards. Think about Michael, running a McDonald's franchise that's technically profitable, but has started cutting corners on food quality and cleanliness to save money. Under a typical retail lease, a landlord might have limited ability to intervene in how a tenant runs their business, as long as rent gets paid. But McDonald's real estate structure gives corporate a much stronger hand. The operational standards are woven directly into the property relationship, not just a separate brand agreement that's harder to enforce. This dual structure, landlord and franchisor simultaneously, is a big part of why McDonald's has maintained such remarkable brand consistency at a scale of tens of thousands of locations across more than 100 countries. But consistency alone doesn't fully explain the extraordinary profitability. For that, we need to look directly at the numbers. Let's get concrete, because the scale here is genuinely striking. In its 2025 fiscal year, McDonald's reported total revenues of roughly $26.9 billion, but that figure actually understates the true size of the business. System-wide sales, meaning total sales across every McDonald's restaurant on Earth, whether company-owned or franchised, reached approximately $139 billion. The gap between those two numbers is the entire point. McDonald's corporate doesn't need to capture all of that revenue directly, because its franchise and real estate structure means it profits handsomely from a relatively modest slice of an enormous, franchisee-driven pie. Here's the number that tends to surprise people most. McDonald's operating margin regularly lands in the mid to high 40% range, a level of profitability that would be considered extraordinary in almost any other consumer-facing industry, let alone one associated with $2 menu items. For comparison, most traditional, non-franchised restaurant chains operate on margins in the single digits to low teens because they bear the full weight of labor costs, food costs, and property expenses directly. McDonald's largely offloads those operational costs onto its franchisees while retaining the rent, the royalties, and the brand licensing fees, the highest margin pieces of the entire business. This is why McDonald's has historically weathered economic downturns better than many of its competitors. When consumers pull back on discretionary spending, fast food often benefits from what's sometimes called trade-down behavior. People who might have eaten at a full-service restaurant instead choose something cheaper, and McDonald's captures a meaningful share of that shift. But even independent of consumer behavior, McDonald's own revenue stream is partially insulated from operational cost pressures because rising labor costs, ingredient inflation, and staffing headaches are primarily the franchisee's problem to manage, not McDonald's corporates. This leads to an important question, though, because none of this is entirely risk-free for the company. If franchisees genuinely struggle, McDonald's ultimately feels that pain too, just with a significant buffer built in. Here's the real reason this model has proven so durable over nearly 70 years. It strategically shifts operational risk away from corporate McDonald's, without eliminating corporate's upside if things go well. Consider what happens during a genuinely difficult economic stretch for a specific franchisee: rising minimum wages, ingredient cost spikes, a slow local economy. That franchisee absorbs the brunt of those pressures directly: thinner margins, harder staffing decisions, tighter cash flow. McDonald's corporate, meanwhile, still collects its rent and royalty payments because those obligations are contractually structured well ahead of the franchisee's own profit margin in the payment hierarchy. The franchisee effectively becomes a shock absorber, buffering McDonald's corporate from a meaningful share of frontline operational volatility. That said, this isn't a risk-free arrangement for McDonald's either, and recent years have shown real friction in the model. Sustained price increases across the McDonald's system, partly a response to inflation, partly a strategic choice, have drawn criticism from some franchisees and pushback from increasingly price-sensitive customers, particularly lower-income consumers, who once relied on McDonald's as a reliably cheap option. If franchisee profitability gets squeezed too hard for too long, or if pricing pushes away exactly the customer base that made the brand a mass-market institution in the first place, the entire system suffers. Because McDonald's corporate revenue is ultimately still dependent on franchisees staying commercially viable over the long run. This tension between extracting maximum value from the real estate and franchise structure and preserving enough franchisee profitability to keep the whole system healthy is one of the most important ongoing balancing acts in the company's modern strategy. Push too hard on rent and royalties, and you risk destabilizing the very franchisees whose success funds the entire model. Push too little, and you leave enormous value on the table that shareholders will eventually expect the company to capture. This raises an obvious question. If this structure works this well, why haven't more restaurant chains built the same kind of real estate empire underneath their own franchise systems? Part of the answer is simply time and capital. McDonald's spent nearly 70 years, and untold billions of dollars, accumulating one of the largest commercial real estate portfolios on the planet, a head start that's essentially impossible for a newer chain to replicate quickly, even with significant funding. Building a real estate empire of this scale requires decades of patient, disciplined property acquisition, not a strategy that can be launched overnight. There's also a structural challenge. Adopting this model requires a company to prioritize long-term property appreciation and rental income over short-term operational simplicity, a trade-off that's genuinely difficult to execute well. Many franchise businesses, particularly younger, faster-growing chains under pressure to expand quickly and show immediate results to investors, simply don't have the patience or balance sheet strength to build a comparable real estate position while simultaneously scaling operations. That said, elements of this model have been studied and partially adopted across other franchise-heavy industries. Hospitality, retail, and even some service-based franchises have incorporated real estate ownership or long-term leasing structures into their own business models, directly inspired by McDonald's example. But few, if any, have matched the scale and financial discipline of the original Sonneborn model, which remains one of the most studied case examples in franchise finance and business strategy programs worldwide. Here's why this story matters well beyond hamburgers. McDonald's is one of the clearest illustrations in modern business of a fundamental principle. The most valuable part of a company isn't always the product it's famous for. Sometimes the real financial engine is something structurally adjacent, in this case, land and property rights, that most customers, and even many casual investors, never think to look for. This lesson applies far beyond fast food. Plenty of businesses generate their most durable, highest margin income from something other than their headline product. A software company's real value sometimes lies in its data. A retailer's most profitable division might be its private label credit card. A gym chain's financial stability might depend more on membership contracts than the equipment on the floor. Understanding a company's actual profit engine, not just its marketing story, is often the difference between a surface-level understanding of a business and a genuinely useful one. The next time you evaluate any business, whether as a customer, an employee, or an investor, it's worth asking the same question Harry Sonneborn effectively asked back in 1955. What is this company actually selling, underneath the product everyone sees on the surface? So the next time you drive past a McDonald's, you'll understand what's really happening underneath those golden arches. It's not just a burger stand, it's the visible tip of one of the largest, most disciplined real estate operations ever built, quietly generating rent and royalties from tens of thousands of locations across the globe, structured decades ago by a financial mind who saw value that almost nobody else at the time thought to look for. The biggest lesson here goes well beyond fast food. Understanding how a business actually makes its money is often far more revealing than understanding what it appears to sell. If this changed how you think about McDonald's, hit like, subscribe for more videos like this one, and let us know in the comments, which company's hidden business model should we break down next?